Good evening, everyone. Welcome to the Loan Officer Training Series with the Mortgage Calculator. Tonight, we're going to be talking about how to structure a short-term rental property loan. So, a very popular topic that people ask us about a lot and something that we deal with a lot here. So, it'll be a great training here tonight. Give us just a moment to go live on all of the different platforms. Appreciate the comments already coming in there. Go ahead and drop a comment there as you tune in. And it looks like we are live on all the different platforms, so we'll go ahead and get it started. Keep dropping comments there in the chat and also drop any questions you have in the chat as we go through the presentation here. So, welcome everyone. My name is Kyle Hershey. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hershey, and our sales manager, Jose Gonzalez. We are a lender that specializes in non-QM loans. And what we do every Tuesday, Wednesday, and Thursday evening at 7 p.m. Eastern on this show is a deep dive into a different loan officer training topic. Tonight's topic, again, going to be very popular, which is how to structure a short-term rental loan. So something we're very familiar with here at the Mortgage Calculator, one of our specialties. So Jose, let's talk about how to structure a short-term rental loan. Also, how to not structure a short-term rental loan as well, right? What is a short-term rental loan and what's not?
Absolutely. We always like to share our tips and tricks and nuggets of knowledge there on short term rental properties and all of these outside the box solutions. Because notice accentuating solutions, right? The investor, the borrower, excuse me, comes to us with an objective in mind. We consult the borrower. There may be some obstacles, and usually that's where we can really shine with our outside the box solutions. I mean, we just uh, recently did that for a borrower. He came in thinking he was going to get a HE loan at 10.25%. Unfortunately, some differences in credit scores there, not what he thought, but now we're able to do a DSCR. Plus, he had some income issues, so now we're able to do a DSCR for the same borrower at 7.125% with a very good, I think it was half a point fee only because of the ultra low LTV. And happy customer and saving lots of money and got twice the loan amount. So tonight's episode is one we really love here: how to structure a short-term rental property loan. um, Now, one of the things I can really state here to our mortgage loan consultants out there is that in order to know how to properly structure the loan, you really need to know what a short-term rental is, how the investor is gaining advantages of operating the property as a short-term rental, or what may not be possible for a property if they wanted to do short-term rentals. So you really have to understand a little bit the short-term rental business. I actually managed a platform for a startup Spanish company, and my wife and I both were managing the Miami market. And this was back in 2015, 2016. So we really got to be involved in the beginning of the short-term rental craze now that it is here, not just in South Florida, but all over the world. And here we are at the Mortgage Calculator providing solutions to the short-term rental property borrower and being able to close their loans effectively without getting running into obstacles because of improper structure. Notice, we love these how to structure series that we're having at the Mortgage Calculator because we like to point out, how to get on the right trajectory, how to avoid pitfalls. And tonight's episode is really, really, it's a great one because the investors, this is the product probably with the most momentum. If you were to pick one of the niches, it would be definitely short-term rental property financing to be able to cater to the many investors that have multiple short-term rental properties, 3, 4, 5, 10, 15, right? And growing because they're making extremely high return on investments. So, like Kyle was saying, what exactly is a short term rental property? Well, a short term rental property is a property that can be legally, and I stress there legally rented by the day, week, month, or any other period less than 6 months and 1 day, because that's what's considered short term, less than 6 months and 1 day in most municipalities. And again, I can't stress enough there legally, especially not just for purposes of the owner and not running into compliance with local zoning ordinances and then getting code violations, but also for financing purposes. A lot of the options are going to require to provide documentation that they've met and are complying with local and any ordinances for short-term rental property. Short-term rental properties definitely have a higher ROI, which is your return on investment, than long-term rental properties. There are many different spreadsheets that you can use to express different analyses of these short-term rental properties. I have a really good one for that, where we throw in different occupancy rates, different down payments, and even the cost for the closing costs and the furniture if the property is not furnished. And you have to throw that into the mix to be able to then come up with the ROI, right? Depending on occupancy and how much money they actually put into the deal, right? The down payment, closing costs, and furnishings and startup, all that kind of stuff. Short-term rentals can be self-managed or professionally managed. That's a personal choice. If you have a great property manager, stick with them, right? Just give them your account information and collect the deposits, basically, right? Now, this is an interesting point, but you got to be, really read the guidelines of wherever you're submitting the loan. Second home loans do allow for properties to be rented short term without a lease, because that's the real big issue. You can't have a second home and then get a lease, and now the property's tied up and you can never occupy it as a second home, right? It's, when the borrowers are not staying there, but do require a certain amount of occupancy by the owner/borrower. That's why I say check the guidelines to see what it is for the loan type, especially if it's non-QM. They could be all over the place on how much is required for the owner to occupy the property in a 12-month period, right? Could be 2 weeks, could be a month, could be 2 months, depends. And then I mentioned already, the short-term rental property has to comply with local and state licensing ordinances, whatever is required. And the short-term rental property, usually there will be no leases that the borrower will be able to provide. If it's a refi, especially. If it's a purchase, you don't have to worry about it. But, if it's a refi, don't have to worry about leases. And usually there won't be any leases unless it's a property management master lease, which is applicable sometimes, where the property owner just gives a general lease and it says I'm going to operate it as a short-term rental for a period of X amount of time, but that's going to be a lease on the property and wouldn't be applicable to use second home financing. So what type of eligible borrowers and properties do we have? Well, first, notice I have there a nice bold type, not to be confused with condo hotels. Because condo hotels are a much more restrictive type of property. First and foremost, the name hotel is going to be somewhere either in the actual name or in the legal description of the property where it says it's a hotel use and all that kind of stuff. That's going to be an issue. Also, the deed restrictions that condo hotels have that usually prevent a significant amount of owner use and also prevent independent property management. You got to put it in the hotel program. That's the real big issue with the condo hotels when you're trying to finance it, right? So, type of properties we're looking at is 1 to 4 unit residential properties. And please note here, very importantly to note, most guidelines the DSCR guidelines is pretty much what we're going to be using, and I'll explain why shortly. But most guidelines will not allow short term rental income to qualify for 5+ unit multifamily property. 1 to 4, yes. 5+, no. Now, I'm not going to say all because I haven't read all the guidelines out there. That's why I said most guidelines, because pretty much the ones that I've read on 5+ units will say you can't use short term rental. That doesn't mean there isn't an outlier out there that allows it. That would be pretty cool. But keep an eye out for that in the guidelines when you're structuring your loans. If you do have a 5+ unit and want to explore the possibilities, start looking at the guidelines for all the options. There's quite a few. And then in terms of borrower types, here's where it's really nice. You're looking at U.S. citizens, U.S. permanent residents, non-permanent resident aliens. Again, I always like to give a little detail on what the non-permanent resident alien is. It is a borrower without U.S. residency status who is living here and working here full time, legally living here and legally working here in the United States, has then and then can um, hopefully qualify for any program with U.S. based credit and the income necessary for the program. But non-permanent resident alien means that they are legally working and living here in the U.S. with some type of visa, and then they get a social security number that says not not valid unless they also present the work authorization document, and that's okay. And then we have our foreign nationals, which is what's really nice. That our foreign nationals can buy a property with a DSCR loan using short-term rentals and really hit it out of the park. So now let's talk a little bit about the structure issues, right? A little bit more deep. Some potential pitfalls that if we can look out for them and structure them properly, we'll be sailing, very smoothly, smooth as silk. So what potential issues are we looking at here on a short-term rental property? Well, first and foremost, depending on the guidelines of the product, and this is applicable more for refis than purchases, the property may be considered a vacant property and the LTV affected with a reduction or a limitation to the maximum LTV if the property if there's not a lease, or if it's vacant. If it's actually vacant on a purchase, keep an eye out that it's not an issue for the guidelines. But on a refi, when it's vacant or when a lease cannot be provided, because like I mentioned previously, right, you don't have a lease on that property unless you happen to have the master lease from the property manager, then it may be considered vacant. Now, none of the options that I mentioned in a little bit of solutions are, but that may happen in some options. And this is usually why DSCR loans are the best option for short-term rental property income properties, because of the flexibility in the DSCR guidelines on the different income streams that are applicable and usable, right? We can use either a lease from the owner for the DSCRs, multiple different DSCR options, but I'm going to generalize a little bit here. We can use a lease, we can use AirDNA, we can use short-term rental revenue reports, bank statements from the borrower, if it's a refi or seller. If it's a sale, same with the short-term rental revenue reports, right? Many ways, or even actually short-term rental comps where the appraiser can provide short-term rental comps on the 1007. Now, another potential issue may be that, and this is where we provide the solutions, right? But you may have a property that's a short-term rental type property. This is why I was saying it's good to get knowledge of the short-term rental business so that you can give the good understand your borrower's position more when they're looking at these short-term rental properties and be able to explain them more, especially to underwriters and account managers. But you may have a property that may have a high cost of the property when compared to whatever is the projected long-term rental income that's possible. What we'd call a trophy property, probably, right? It's really nice, great location. You're going to hit it out of the park as a short-term rental, but what's your situation now, right? With a regular DSCR, you may be stuck unless you do obviously a low or no ratio, other option that I'm going to talk about. But the DSCR options that we have allow the use of short-term rental income to overcome that issue. So you can get those trophy properties, especially if you have AirDNA comps nearby. That brings us to our next point here. Another potential issue with your short-term rental property loans is scarcity of short-term rental comps, because then that's going to limit the use of AirDNA again, right? Now, AirDNA has a version that is accessible to the public. You just have to register for it, and then you can do your research, your preliminary research that way as well. In some cases, the underwriter may want to pull their own as a quality control check, but you can definitely go check the databases and see what that is. But scarcity of short-term rental comps is going to limit the use of AirDNA, limits the appraiser completing a thorough 1007 with short-term rental property comps, right? So that's definitely going to affect us. And then at that point, if there aren't any short-term rental revenue reports or bank statements from the seller, then you're going to be stuck with using long-term rent, right? And then another point, not as doesn't happen so often anymore, as the guidelines of DSCR loans have um, softened up regarding short-term rental properties, right? They're really embracing the industry because they've seen how big it's grown and they want market share. So that's why you're seeing all these great options now for short-term rental properties. But in some cases, limited or no short-term rental experience by the investor will negate that option. So make sure you look for investor experience when using short-term rental income, and make sure that there may not be, separate from whatever months you need to provide for the property, they may require a certain amount of short-term rental property rental management experience for the borrower. I have seen that. So bottom line here, like with every non-QM loan, make sure to review the guidelines and ensure that there are no experience related requirements, whether it be for short-term rental or just investor experience in general. So in now structuring our loan, we talked about what it is, talked about potential issues and pitfalls to avoid. So now, what are the ways that we could structure our short-term rental property loan, right? Well, the investor special, like I like to call it, right, for where we can qualify the short-term rental properties with DSCR using long-term rental income. I was just alluding to that previously, talking about the no ratio. Well, again, it's always easiest if the guidelines allow you to use long-term rents to qualify. In some cases, even if you're using the property as a short-term rental, you can use long-term rental to qualify, even on a refi, if that'll qualify you and avoid a lot of paperwork, depending on the loan amounts and taxes and insurance and all that kind of stuff in your DSCR. But again, obviously 1.25, and 1.5 is awesome when the long-term rent covers, and the guidelines do not have any short-term rental restrictions, right? That's the key. Always make sure no 5% LTV reductions for using short-term rental income. That was pretty common a while back, but as the guidelines for DSCR have more embraced short-term rental properties, more and more have loosened their guidelines by eliminating that LTV reduction. And that's essentially what that is. That's a loosening of the guideline when you're basically getting higher LTV for what was previously considered a riskier product, like short-term rental, which now they embrace it. And again, for the trophy properties or where the where the long-term rents may not cover, but you still want to get it, we have our low ratio and no ratio. The no ratio is the less than 0.75 and the low ratio is 0.75 to 0.99 DSCR. So those are really good options as well. 75% LTV max on the purchase, but also 75% LTV on the refi cash outs as well on that one. So obviously that's the easy button on the short-term rental properties, right? It covers, that's it, no harm, no foul. But in the scenario where you need a little bit more, then we have our short-term rental specific options, right? This is where we break it down, when we scour the guidelines, the many DSCR options that are out there, and we basically want to make sure we have all of the best short-term rental property conduits available for our loans. So this is just a synopsis. This is not the only thing we can do because there's many guidelines. Just want to give you a little summary, and on the right there is a sample excerpt from a guideline on using short-term rental. But basically, our short-term rental specific options, which I alluded to a couple of slides ago, you have AirDNA, which is a database that allows us to use projected income from the short-term rental property, with the short-term rental property obviously operated as a short-term rental property, and then you need to get a certain number of comps. They usually want 4 or 5 comps, and you're gonna need the normal parameters like you would for any other comparables, right? Proximity to the subject, the style of the subject, like the year built, newly remodeled, all that kind of stuff. And then those are the two biggest components. Then obviously bedroom count, gross living area, similar. You're not going to compare a 10-bedroom house to a 5-bedroom house, even if it's on the same block, because not only is the gross living area going to be different, but the utility is going to be so different, 4 bedrooms versus 10, especially on a short-term rental. But again, AirDNA, the data is there available to everybody, right? So you can go access it and see, do your research, empower yourself so you can make some great decisions, and then you can reach out to me or your mortgage loan originator, friendly neighborhood mortgage loan originator, to make sure that the property meets the debt service coverage ratio that you want to do, and then full speed ahead, up to 80% loan to value using AirDNA, 80%. So just keep in mind that in some options, using AirDNA may have a DSCR restriction or an LTV restriction, like a minimum DSCR of 1.5, usually on the option that doesn't reduce the LTV, but they say, sure, we'll let you use AirDNA for the full amount, but you got to have at least a 1.5 DSCR. And in some cases, they don't have the minimum 1.5, but then they reduce the LTV by 5% from their highest LTV. So if their highest LTV is 85, now you're getting 80% at the 85 pricing, or their highest LTV is 80, you're getting 75. You're getting 75 at the 80% pricing to be able to use the short-term rental. So moral of that story is always look at the guidelines. But obviously the short-term rental specific options allow us to qualify with a higher rental income, and we can use that for purchases. And now they're even letting you use it for properties recently put into service as short-term rentals, and then you don't have the 12 months of revenue reports. We have options that will let you use it for refis, cash out refis. So that's pretty amazing, right? Then the more standard, using 12 months short-term rental revenue reports from platforms or bank deposits, can be a purchase if the seller provides the docs, or if it's a refi, then the borrower needs to provide the docs. Usually if you have less than 12 months, let's say you have 9 or 10 months, you may get the exception, but you'll have to average it out over the year, right? Whatever 10 months income you got, average it out over the year instead of the 10-month average, because you only have 10 months. And then we have the scenarios where the appraiser can actually find short-term rental comps and add them to the 1007. But in that case, the appraiser usually has to comment on the seasonality of the short-term rental comps and adjust accordingly. And that's why I put there, all of these options are subject to an adjustment for expenses. Sometimes they do, sometimes they don't. They hit you with a 25-30% reduction off of the revenue. Usually that could occur for any of them, depending. That's in the guidelines. They may tell you, yeah, that's our management fee adjustment or whatever. So that does vary from guideline to guideline. So if talking about guideline, if you look at the right over here, right, you're going to see that hold on a sec. you're you see the where it says option two. Option one was just using long-term rent. Option two is using the 12-month look back period to determine average rents or annual or monthly statements. That's where I say you may get a hit um, with that situation where you don't have the full 12 months. That's okay. If it's a good, if the seasonality part is that you just hit the high season and now you got 2 months or 3 months, it may not make that much of a difference in your overall average. And then option three, now that's the unicorn, right? Now notice in this guideline, it's pretty favorable. They're saying we only need a DSCR of 1.15 to be able to use the Air DNA, which is pretty amazing. And notice it says available only on purchases or recently renovated refinances. And then it gives a little bit more, breaks it down a little bit on how they want to do the forecast period, minimum 50% occupancy, divide whatever Air DNA comes up as the annual income divided by 12. And then you need 5 comparison. That's this particular guideline. Another one could say 4, but they could say 1.5 DSCR. So notice the part I talked about must be similar in size, room count, amenities, availability, and occupancy, because these comps do have occupancy calculations are also there. And then notice if it says if it's a 2 to 4 unit, you need an Air DNA report for each unit: Unit 1, Unit 2, Unit 3, and Unit 4, or as applicable. So you can see how we break it down with the DSCR guidelines, how they've really embraced short term rent, and how we at the Mortgage Calculator are always trying to stay at the forefront ahead of the curve with the short term rental properties, the short term rental financing, and really helping meeting and exceeding, I would say, the expectations of our borrowers on these short-term rental properties. So really looking forward to helping as many of you both loan officers and borrowers out there, structure your short-term rental property loans.
All right, it looks like we have a couple questions here. So we'll pull one up on the screen here. The first question is, can DSCR be used for senior care, addiction recovery business if borrower runs that business, like a single family home?
Yeah, that's we actually get a lot of that, not necessarily for recovery addiction, but definitely for the senior care, like the ALF, ACLF kind of a scenario where they're running it out of a modified single family home legally. They get, like a certain number that they allow per square mile and stuff like that. But what it boils down to in the financing is going to be that now that's a commercial use, right? That's not a residential rental. So that's where it deviates from the plan. Now we do have options that do DSCR on a single family home, and we'll do that because we closed them, right, through a more commercial type conduit where they will check the zip code, and if it's not in a population density area and all that kind of stuff, they won't do it. But other than that, they'll do it. But the main key in that setup is that the property can't be modified, like extremely modified. Like it has to have the regular kitchen, the regular everything. Yeah, you can have guardrails in the bathroom and stuff so that the older folks don't slip and fall, but you can't have like eliminated the kitchen in the way that they do in some commercial properties. It has to be a regular house, and then you just have people sleeping in the rooms. That's about it.
All right. Next question is, can investor DSCR if he rents out all rooms with leases? Property will be non-owner occupied.
Yes, we're getting the good ones today. These are the very common real house hacking investors here trying to totally tweak and maximize the ROI, because now it's very common in areas like where they're renting like boarding houses, or now more for student housing where you have individual leases. in each room for each student, right? I went through that with my daughters, but I would tell you it really depends on the guidelines because they will usually not do a boarding house in a this regular residential DSCR that we're talking about, and the individually rented rooms like that also is an obstacle where that usually how that's the workaround for that has usually been you get a master lease from the property manager, right? And then the property manager gets individual leases from each occupant. So the master lease is presented for purposes of a lease, if you're using that, and then that usually satisfies a lot. But you got to watch it because it's depends on legal use of the property, zoning, and all that kind of stuff. Because if you have a non-compliant use of the property per local zoning, the appraiser is going to put non-compliant use, and then you have to look in the guidelines and see if they will accept non-compliant uses for a property. A lot of times they won't, and then you're going to be stuck. And so those are very good questions.
All right, next question. Is there a minimum FICO score for these programs?
Finally, an easy question. Yeah. Well, for our DSCR options out there, not necessarily any of the ones that I may have extracted information from tonight, but we do have a minimum credit score of 575 on our DSCR. I would say that there's probably a short-term rental utilization within that guideline of that option that allows as low as a 575. That's at a 65% LTV, by the way. But yeah, most of these will let you go low, 600, 620, 640. But you're just going to have to adjust the loan to value, usually what it boils down to, and then review the guidelines for those options because that's how the whole structure begins. First and foremost, we're looking at property loan amount, right? Because depending on the minimum loan amount, you're eliminated a bunch of options, right? Loan amount, property type, 1 to 4 unit, or 5 plus, which would be more difficult, and then after that. All of these other components that we were talking about for the property, and then see what hits, regarding FICO score, regarding LTV, purchase price, loan amount. Usually you make an adjustment and then search your guidelines specifically for the short-term rental component to make sure that it's a viable option for your borrower's objectives.
All right. I don't see any other questions, so I think we can go ahead and wrap it up. Remember, we do this at 7 p.m. Eastern every month, or Tuesday, Wednesday, and Thursday. So be sure to tune in. We will see you next week on Tuesday. So thank you, Jose. That was a great presentation here today. Again, something very popular out there. So make sure everybody's trained up on it for sure. So
All right.
huh?
Thank you, man. No, thank you. You guys are welcome. Embrace it, and you will make more money as a loan officer. I can guarantee you that.
All right. Well, thank you everybody tuning in, and we will see you next Tuesday at 7 p.m. Eastern for the next episode of the Loan Officer Training Series.